Joining me now is Michael Landsberg. He's the Chief Investment Officer at Landsberg, Bennett Private Wealth Management. Michael, welcome to the show.
Great to be here.
All right, so we are about 30 minutes away from the start of today's session. What are you going to be following most closely?
Ashley, we're going to see if we get the follow through for what we saw yesterday. Obviously, markets are a little bit nervous given the fact that there's a potential for trade talks / war to start up again. And I think that's important to see how the market reacts to that. Data's been good so far, so we're excited about that, but it'll be interesting to see how this plays out.
All right, and earnings season is upon us again.
I think what's happened is typically we've been a little bit more optimistic than the rest of the street for the last couple of quarters. It seems like the rest of the street's been playing catch up. The last quarter, most of Wall Street was at 2.8% earnings growth. We ended up getting 12.8%. And I think this quarter we're seeing a lot of people that are still, they're at 7, and we think we're going to see double digits again. So I think what's happened is we're seeing exceeding expectations, earnings are being met. But I think at the same time, what we're seeing also is I think people are playing catch up. I think a lot of times the earnings, maybe it's political, maybe it's whatever, they don't believe in this rally. And I think what's happened is earnings come back to show everybody, hey, the economy is actually in pretty good shape, and stock earnings are very strong.
All right, and CPI data is coming out tomorrow morning, 8:30 a.m. What are you anticipating?
And we're going to see a bump up, and I think probably to see around 3.1%. I think that's, we've got some chop here. I think we're going to see higher months, a little bit lower months, but I think the trend's going to be a little bit higher over the next couple months. I think what's interesting here is, given the fact that we have no other government data because of the shutdown, I think normally if you saw a bump up over 3%, the Fed might pause. I don't think you're going to see that. I think the Fed's going to kind of continue, and they're going to cut 25 this next meeting. But I think it is interesting the next two meetings after what happens with CPI data. Does it come out stronger or weaker? And that's going to, I think, it'd be interesting what happens in December. I'm not guaranteeing a December cut at this point.
Well, that's what I was going to say. Over 95% of investors at this point are anticipating 2 cuts before the end of the year. What do you see for the Fed into 2026, Michael?
Typically what I think is we as the street prices in too many cuts. Too many raises, too many cuts. I think what's going to happen is I think you'll get your couple, probably between now and the end of the year. But I think what's going to happen is if inflation starts to creep back up and the labor situation doesn't get any better, I don't know what's going to happen there. I think you might get one in the first half of next year, but I think it's going to depend really on what happens with Chairman Powell, with the relationship with President Trump. Does he feel the need to kind of continue to do this, or does he wait and see what the data is going to say? And I think right now, the data from where we sit is pretty good. I don't necessarily know if we need all these cuts. Earnings are really good. Stock market's near all-time highs. It's not like we need to get things going. Yes, the labor situation's not great, but at this point, it's not really to the point where I think we need lots and lots of cuts, given the fact that we're near all-time highs in most major asset classes.
And what are the pros and cons of cuts in general?
Well, typically what you see a cut is you want to get things kind of moving, if you will. So I think in an environment where the economy is starting to stagnate, you want some cuts to be able to kind of get things going. The issue we see is kind of reminds me, if you go camping, do you throw gasoline on a fire and you have a really bright fire for 30 minutes? Or do you throw some logs on there and get the burn for 3 or 4 hours? My concern is if you have an economy and earnings that are doing already pretty well, stock market's near all-time highs, you start cutting more and more, do we get a melt up? Then all of a sudden we don't have anything kind of fuel, if you will, to burn in this back half of the second half of next year, then all of a sudden we're starting to stagnate. So that's the concern I have, is if we don't need cuts, why have them? Because I think you just move the kind of the 2 or 3 year run in earnings to 6 months. And all of a sudden it's melt up, which is great. But the problem is we don't have anything to burn after that, and we start to stagnate.
And I understand that you say the market is continuing to climb against a wall of skepticism. Can you elaborate on that?
Before, obviously, October 1st, we kind of lost the government shutdown, the CTFC shutdown data from the government. But going into the October 1st data, most people were actually short the S&P 500, like the institutions. Not the folks that come on the show and tell you how great things are going to be, but their actual positions were short S&P 500 and very short the Russell. So it's not like a scenario where everybody's bullish. Lots of people were negative. In fact, actually, I think the Russell was in the 90th percentile in terms of negativity as it's continued to make some new highs. That's a positive, because if everybody's really bullish about things, I worry about, okay, who's the next incremental buyer? With the fact that we saw some rallies in the summer, it's because a lot of people were short this market and had to buy it when earnings came out better than expected. So I think that's a positive. But it's not as though everybody is really, people might talk a big game, but their positions indicate something different, that they're very pessimistic. And a lot of participants have not participated in this rally to the extent that you'd think they would have.
And given the recent volatility, how are you advising clients right now?
I think what's happened now is, I think when we look at clients, the volatility a lot of times is concentrated. We've had performance in about 7 or 8 stocks the last couple of years. And it's broadened a little bit, but I think what's happened is people are too concentrated in basically one sector, which is tech, and really one theme, which is AI. So we've encouraged people to take some money, look outside of just AI. There's other sectors that are growing. And in the last quarter, there's about 30 stocks that actually did better than the Mag 7 in terms of earnings. Start to look to diversify yourself outside of those. I think traditionally, people always looked at diversification as tech and healthcare and utilities, et cetera. And I tell people, taking a step back, you need to look at AI and say, you're not properly diversified if everything you own, whether it's utilities, industrials, energy, and tech, is all in the same theme. I think we've lost some thematic diversification. People are stuck in one theme, saying, hey, I've got 6 sectors, but every sector is relying on AI. Again, AI is our largest theme, but it's not 100% of our process. We're going to own things like cybersecurity, things like the aging of America. Obesity is a trend for us, and new energy. Those are things that are outside of the world of AI to give you some diversification, not just be tied to one sector, because again, that increases your volatility.
Michael Landsberg, thank you so much for joining us today at the New York Stock Exchange.
My pleasure.